Listen up, because the market isn't just shifting, it's transforming. And if you're not paying attention, you're going to get left behind. Right now, we're watching three massive market forces collide. Central banks playing chicken with inflation, crypto roaring back with institutional firepower, and a new wave of tariffs threatening to shake the global economy. This is huge. What's coming next could make or break investors in 2025. You need to understand what's happening and how to play it. Let's get into it. We're starting with the most dangerous game on Wall Street, the Fed's rate policy. Investors are practically begging for rate cuts, chanting for it on every street corner. But is the Fed listening? No. They're dragging their feet, taking their sweet time. And you know what happens when you keep investors waiting? They lose their patience and things get ugly. The Fed's narrative is that inflation hasn't cooled enough. They're pointing at those CPI numbers like they tell the whole story. Even billionaire investor Stanley Druckenmiller recently warned that the Fed may have already missed its shot at a soft landing, and the longer they wait, the riskier it gets. But let me tell you something, the market's smarter than that. The market's looking ahead, looking at leading indicators like job growth, housing demand, and consumer sentiment. And you know what it's saying? Let's go. It's time to cut rates. Here's the trap. If the Fed cuts too late, it risks missing the window for a soft landing. It'll be like trying to land a jumbo jet on a postage stamp during a hurricane. And if they hold too long, they'll choke off growth and trigger a deeper recession. It's a lose-lose unless they get the timing perfect. And let's be honest, folks, timing has never been the Fed's strong suit. Meanwhile, the bond market, the smartest guy in the room, is flashing warning signals like it's gone full-on disco mode. Yield curves are more inverted than a yoga instructor. Rate-sensitive sectors like real estate and banking are already under pressure, feeling the heat. But here's where it gets really interesting. Tech isn't flinching. Big players like Nvidia, Meta, and even Amazon are shrugging off rate fears like they're nothing but a pesky mosquito. Why? Because AI demand is driving a secular boom, a tidal wave of innovation that the Fed can't stop even if they wanted to. The Fed can't kill innovation with a quarter-point hike. It's like trying to stop a runaway train with a fly swatter. Bottom line, the longer the Fed delays, the bigger the market snapback will be when they finally come to their senses and pivot. And when that snapback comes, it's going to be explosive. Can't talk about market shifts without touching on the AI investment boom. What started with a handful of buzzwords is now a multi-trillion-dollar catalyst. Just look at Nvidia. It's not riding a hype wave, it's selling real hardware, powering real infrastructure for real clients. And it's not alone. Microsoft, Amazon, Google, they're all pouring billions into AI integration and cloud expansion. And here's the kicker. AI isn't just tech, it's touching healthcare, defense, energy, finance, virtually every sector. That means this isn't a bubble, it's a backbone. Smart investors are positioning in semiconductor stocks, enterprise software, and companies building the picks and shovels of the AI era. Because when a trend is this big, you don't chase headlines. You invest in the plumbing. The rotation into risk assets will be like nothing we've ever seen. Now let's talk about the most surprising comeback of the year, the one nobody saw coming, crypto. That's right, Bitcoin and the gang are back, and they're not messing around. Bitcoin is no longer a fringe asset, the playground of nerds and anarchists. With the approval of Bitcoin ETFs, we've officially entered the era of institutional crypto. This is the big leagues, folks. BlackRock, Fidelity, ARK. These aren't your Reddit traders posting memes and YOLOing their life savings. Larry Fink, the CEO of BlackRock, even called Bitcoin digital gold, and now he's backing it with a spot ETF. That's not speculation, that's conviction. These are trillion-dollar institutions, the heavy hitters, the smart money. And they're making long-term bets on crypto, not just dipping their toes in the water. And it's not just Bitcoin. Ethereum is regaining momentum, flexing its muscles. Solana's making noise, turning heads. Coinbase is scaling up, becoming the Goldman Sachs of crypto, with regulatory clarity finally coming into view. This is not a drill. Why does this matter? Because we're heading into the post-halving phase of 2025, and historically, that's when the fireworks start in crypto land. But this time we're not relying on meme hype and Twitter influencers. We're talking about real capital, real infrastructure, and real utility use cases driving the space. This is not a fad, it's the future. Even the most conservative investors, the ones who still think Bitcoin is used to buy drugs on the dark web, are reconsidering their 1 to 2% portfolio exposure to digital assets. That's a massive shift, a seismic change in the investment landscape. If Bitcoin breaks its previous all-time high, and I think it will, watch how fast Wall Street flips bullish. They'll be tripping over themselves to get a piece of the action. We're not saying it's guaranteed, but the setup is there, flashing green like a Christmas tree. And hey, if this is the kind of insight you wish the mainstream media actually explained clearly, give this video a like. It helps push it to more investors who need to hear it. Now, while all eyes are on rates and crypto, there's a geopolitical undercurrent most people are ignoring, a silent storm brewing on the horizon: tariffs. That's right, those pesky little taxes on imports and exports are about to make a big splash. April 2nd could be a flashpoint, a day that will live in infamy. That's when new rounds of trade policy announcements are expected, and let me tell you, they could disrupt everything from the semiconductors that power your smartphones to the agriculture that puts food on your table. This is bigger than just the US and China, folks. This is a global realignment. Europe, India, and Southeast Asia are all reshuffling trade routes and production strategies like a game of high-stakes chess. Deglobalization is real, and it's happening faster than you think. It's creating winners and losers in real time, right before our eyes. Companies with US-based manufacturing, they're suddenly more attractive than ever, like the prom queen at a high school dance. Firms overly reliant on Chinese supply chains, they're exposed, vulnerable, like a sitting duck. This shift is going to accelerate trends in energy independence, domestic tech, and even defense spending. It's a whole new ballgame, folks. Smart investors are watching shipping indexes, commodities futures, and international ETF flows like hawks, looking for any sign of weakness or opportunity, because when the rules of trade change, the market follows. Fast. If you really want to know where the market's headed, follow the smart money. Right now, hedge funds and institutional investors are quietly rotating into sectors that benefit from volatility, rate pivots, and geopolitical realignment. We're talking about energy, defense, AI infrastructure, and domestic manufacturing. ETF flows are confirming this. Money is pouring into funds like XLE, XLI, and SMH, targeting real-world assets and long-term innovation. And insiders, they're buying again. Not in meme stocks, but in boring high-margin businesses with pricing power and global exposure. These moves aren't making headlines, but they're positioning for what's next. So while retail investors chase headlines, smart money is quietly stacking conviction plays. Now let's not forget what the market has already taught us. Remember, those who cannot remember the past are condemned to repeat it. In 2010, we saw a multi-year bull market born from cheap money and tech innovation. It was a glorious time, a time of prosperity and growth. But then came 2020, and we saw how fast markets can crash, faster than a meteor hitting the earth. But we also saw how even faster they can recover when liquidity floods back in. It was a wild ride, a roller coaster of emotions. And in 2022, we witnessed how inflation, interest rates, and global conflict can flip everything on its head, turning the market upside down. Each of those inflection points reshaped the investment landscape, changing the rules of the game. And guess what? Right now, we're at the doorstep of another one. The alarm bells are ringing, folks. The lesson? History doesn't repeat, but it does echo. When you understand the past, you can position for what's next. Smart money isn't guessing, it's watching the patterns, connecting the dots. Everyone's watching the charts, trying to predict the future. But let me tell you something. If you're paying attention to the shifts, to the underlying forces driving the market, you're already ahead of the game. The Fed's next move could trigger a bull run, sending stocks soaring. Crypto might be in the early stages of its next supercycle, a once-in-a-generation opportunity. And the tariff wave? It's going to redraw the global investment map, creating fortunes for those who see it coming. So what's the real trigger that will send this market vertical? The catalyst that will ignite the rocket fuel? I'll break it down in the next video. Don't miss it. Hit subscribe and turn on the bell so you don't miss that drop.